Hi everyone. Good afternoon. It's an honor to have Jay with us again. If you listen to him last time, and that's the case most of the time. You made a lot of money. He made a call for copper, and for the start of the Santa Claus rally, which we think and agree with him that it's just starting. So I'll now turn over to him so we can go on with today's lives where he has a very interesting theme. So thanks again. Great to have you, Jay.
Thanks, Roberto, and great as always to be with the OHM research community. Yeah, we've had some really good chats over the last now 9 months or so that we've been doing this, and last one was a great one. We talked about Dr. Copper, and he answered the call as we as we touched on. I think last week was the best week for copper in 5 years. It was up 10%. So we don't always time it that nicely, but certainly that was a nicely timed discussion. So yeah, you're right. I mean, I think the musings on Friday was titled "Gut Game," and really the musing part was talking about the gamification of the economy, right? And we've kind of been familiar with the idea of things becoming games and gamified with Robinhood in the mime stocks in the spring and over the winter of last year. But now I think with all the action that's gone on in the energy complex, that it seems to me that the gamification is spreading into the real economy. And I think that could be problematic. And so what I mean by gamification is really the significant increase in the importance of the spot markets for key commodities and key energy providing issues like oil, coal, uranium, etc. So we had the Robinhood saga at the beginning of the year. We had the lumber spike in the commodity space, and then iron ore, the same thing, big spikes up and sharp drops back. But now we have it in the energy sector, which is creating, a lot of anxiety amongst the consumer base, concern at the governmental level, leading to perhaps some policy issues, and even into the central bank world and into the world of monetary policy. So it worries me a little bit that what I think is just kind of the gamification, right? Financial speculators have figured out that the nexus of pain is in the spot market, and basically repricing the spot market for the long-term users of people who come in and buy in the spot market, namely utilities, have found themselves in real trouble. My concern is not so much that, but the concern that these issues can spread into policy, into the policymaking government apparatus, and perhaps even more importantly, into the central bank apparatus and decision making around monetary policy, which could then create kind of this feedback loop, which could be negative. So, for example, if the gamification of spot energy markets leads to the perception of significantly higher inflation, which pushes central banks into tightening earlier than they might otherwise have done, even before the actual inflation comes, down the road. And if it is just a gamification, i.e., speculative financial capital going into the real economy spot markets, playing games, and then moving on to the next game, as we saw with lumber, as we saw with iron ore, as I think we're going to see with the energy markets. We already have European energy, natural gas prices have already come off dramatically. And I make the example in my musings about the shipping containers, right? All these concerns about supply chains and hundreds of ships. All of a sudden, there are like multiple people counting ships outside the ports of Los Angeles and Shanghai and et cetera, and telling us that there's hundreds and hundreds of ships waiting to either get filled or unload, and what that means for Christmas. And, no one's going to be able to buy any Christmas presents. And, all this, it seems to me to be like off the charts kind of extrapolation. And so it worries me because I differ. I disagree. I think this is gamification of the real economy and of the spot markets. I think the real economy is going to adjust itself much more quickly than people think. The idea that we're going to be still suffering from, supply chain shortages across the board 6-9 months from now, I think is going to be proven completely wrong. And so the gamification idea, I think, is really a little bit of a game for economists and media types who are just trumpeting the shortage economy. I think the Economist or the New York Times or one of the big papers, big magazines had the shortage economy. We're not in a shortage economy. I disagree pretty wholeheartedly. So to me, I think a smart Fed is going to be a patient Fed. I do worry that this gets brought into the policymaking circles. So far, it hasn't really happened, but that's one of the concerns. I do think, as we've seen with energy prices in Europe, they've already come off significantly, and even the shipping container prices have come off dramatically. And I made that point again in the musings. And so I think by the time, in another month or two, we're going to be on to something else. But I just thought it was kind of interesting to see how this price action that we've started with Robinhood and the meme stocks has now gone into the energy spot markets and even into the shipping container space. Who knew that there were, spot markets for shipping containers? I didn't know that. I guess maybe I should have, but I was surprised.
No, it's very interesting, and again, and to name some of those media vehicles, I think when they mention something, I mean it's totally in the price. I guess now you made a very interesting point, and I want to refer to that on the musings about demand destruction in Europe. So. A lot of people have been saying, okay, watch out for the third quarter results, especially in the big industrial names in Europe, and look at how much demand destruction we're seeing, and which names are being able to pass on price increases to their customers. So I would love to hear your thoughts on that.
Well, I think there are a couple of thoughts, right? One is the idea of a broad-based demand destruction in terms of affecting the overall economies, right? And I did mention in my musings an interesting scenario analysis that Morgan Stanley did, where they projected a 500%, so an important number, 500% increase in the wholesale price of natural gas in Europe, and extrapolated out what they thought that would mean for European GDP next year. And broad European GDP is forecast to grow about 4.5%. And their conclusion was that a 500% increase in the wholesale price would take off roughly 40 basis points of GDP growth. So 40 basis points out of 4.5%, not even really 10%, with a 500% increase in the wholesale natural gas price. So I think that is those kinds of things I think are helpful, and I keep my eye peeled for that type of stuff because it puts things in context. All the headlines, all the news, anyone, you can get all hyped up and all worried about stuff, and then you sell and you realize 6 months down the road the GDP is 4.3 instead of 4.5. Who cares? Nobody. So that's the big overarching economic point. The other point, more important, I think, for investors, as you raise, is the earnings point. And there, I thought it was interesting. I don't really know the impact on European projected earnings, but I do know in the U.S. that I think it was J.P. Morgan noted that Q3 earnings in the U.S. are forecast to be down about 7% versus Q2. And that's a fairly significant decrease, and so that's the forecast number, and so they actually were making the point that they think the bar is a pretty low bar to beat. And I would just make a third point, and that's in the U.S. at least. I would just make a third point, which is that, everyone's worried about inflation. And keep in mind that inflation means companies can pass, price increases through. And so I do think that if you look at the early, certainly the first blush of earnings that come through in the U.S., that's been the case, where earnings have been better than expected, and that the top line has been better than expected. So I think, in essence, we're in this transition period still, right? Remember, I wrote my monthly a couple weeks ago, was titled Transition Time. We're in that transition within the economy. And so it is going to be a little bit challenging. But one of the good things about, being an ETF focused investor as I am, you don't really have to worry about those specific companies that are going to take a hit that maybe weren't able to manage their approach properly. The ETF gives you kind of the comfort of not having to worry about that one specific company. And I think that's one of the reasons why I've always liked the ETF space, because it allows one to focus more on the theme than on the individual micro company, which has a lot more variables around it that are a lot harder to fully understand or even predict, I would argue.
Yeah, no, that's great, and there's a very interesting question here from the floor on the gamification, he's looking to understand a little more the specifics of these spot markets, because what he's suggesting is it's pretty hard to be in these markets if you're not an established player in commodities and so forth. So what he's saying is that it's not that clear to him how that happens, especially on the logistics.
I'm not sure I really follow the question, Roberto. Is the folks watching, is he talking about asking for more color around the spot market with the energy?
On how the gamification, exactly how the gamification of these commodity spot markets work. Yeah.
Sure. Okay. Well, yeah. I mean, I'm not a commodity expert either, but my understanding of this is that utilities typically have long-term contracts, right? Where they buy the input that they convert into electricity from the provider on a long-term basis. So those contracts are set and everyone moves forward. And there is a portion of the supply that they buy on the spot market. And this was very visible in the uranium market over the last couple of months, right? As you know, we've been in the uranium space in both our model portfolios for 4 to 6 months now. I can't remember exactly when we initiated the positions. And what happened in the uranium market was that that's certainly been the case. So since Fukushima in 2011, 2012, the uranium demand for uranium's obviously declined considerably. Companies, utilities who needed uranium for their nuclear plants continued to have those long-term contracts with the folks mining the uranium, but increasingly depended on the spot market for a portion of their needs because the price was going steadily down. So it made sense, right? And what happened in the uranium market was that a Canadian financial firm launched a ETF, or not an ETF, sorry, a trust. Sprott is the name of the company, SPROTT. You can look it up. And established a physical uranium trust with an at-the-market buy provision. So they went into the physical market for uranium and bought and bought and bought. And as a result, the spot price went up dramatically, and the utilities found themselves in a lot of trouble, because if you're an electric utility and you need natural gas or coal or oil or uranium to run your power plant, you need it. You don't have the luxury of saying, oh, I'll wait till next week when the price goes down. And that's what I mean by gamification. It's a smart move from the Sprott player perspective. It's a smart move for people in the financial community to recognize this potential for price appreciation in uranium, but it's more of a gamification than it is any long-term significant shift in supply and demand, and therefore price of energy. And that's why I say I think it's like lumber up and down, iron ore up and down, uranium up still, natural gas in Europe up and already came back in sharply because Gazprom and said they would produce a little bit more gas through the pipelines, and Putin said that they could, work out some arrangement.
Yeah. For the right price, yeah.
Yeah, for the right price. And again, that we're long Russia as well, and doubled our position there several weeks ago. So we're a big believer in the idea of energy. And as you know, I've made the point since like over a year now that you can make money in clean energy and in fossil fuels. And it's been an opportunity to make money in both. And that has obviously really played out. One of the reasons why the models are having a pretty good year is because we're quite long uranium, Russia, XLE, carbon, etc. It's a big chunk of our model portfolios, both thematic and global multi-asset. But that's what I mean by gamification. The uranium one is probably a really good example to look at because you can see that it was a financial, player who came into the spot market and disrupted what has been a very cozy relationship between the utilities and the spot market. Spot going down for years and years. And so they just did more and more of their buying on the spot market. A smart financial guy came in and recognized the opportunity and, basically blew up the spot market. And now,
it's a great example because you remind me of something that happened just today. Kazatomprom, which is I think it's the biggest global mining in Kazakhstan, the biggest uranium miner in Kazakhstan. They have announced that they'll set up a fund, they'll set up a structure where clients, basically retail investors, can buy into physical uranium. So guess what? They help people prop up the uranium price, which they happen to mine themselves. So I mean,
They basically brought in a new buyer.
Yeah,
they're bringing in a new buyer and consolidating it. And guess what? Our uranium position today was up 5%. Thank you very much. On the back of what's already been, it's on the back of what's already been a dramatic price appreciation in the uranium space. But yes, this is kind of what I mean. These are financial, whether you want to call them innovations or disruptions, what have you, gamification of what has been pretty traditionally hidebound or stable energy markets, and now they're being disrupted a little bit, and folks are realizing that it's kind of like living by the sword and dying by the sword. If you're going to live by the spot market for something that you absolutely have to have, then don't be surprised if you get caught out one day and you get in a lot of trouble. Meaning that if it's critical, you probably shouldn't depend on the spot market for it.
Yeah.
And so, I do think that's, but again, my concern as investors, we can profit from this. My concern is that it creates an environment of worries about inflation, worries about shortages, which feed into expectations, which create action at the policy level, which could create a feedback loop that would be problematic and not based on reality. The reality would be that higher prices will, traditional economics says higher prices lead to more supply, and that will smooth out the imbalances, and we won't have this shortage economy, which is what I tried to end on in my first chat about this. That the point is that I don't believe the real economy is going to be that hamstrung by these issues. I think the real economy is going to respond much quicker than folks think. And so this idea that we will be spending much of 2022 in a shortage situation, I think is going to be wrong. That's
Yeah.
the point I really want to make.
No, I agree. And following up, I mean, we it seems like people have been looking. I mean, I'm not saying these are non-issues, but I think people have been looking for an excuse to be bearish. So now there was, I mean, there was COVID, of course, which led to a lot of shutdowns and in the third quarter. But with exception of maybe the UK, but there has not been any new variant and no new surge in cases. So, at least in Europe, Asia, in US, things seem to be pretty much under control. I guess, the banks, when they report in the US, I think the guidance was pretty strong, and the banks are sitting on a ton of cash and a lot of liquidity, earning zero. So, and JP Morgan and the others made positive comments. And now, Russia has, come to the rescue, of course, for the right price to the gas situation in Europe. So, I mean, there's nothing missing, for the continuation of the global rally. I mean, of course, people are nervous, and to add to that, I mean, there's I want to go to your point on the dollar and on tapering, because people seem to be nervous about tapering, and there has been the last inflation report, which was in my opinion good, because it basically there was no negative surprise. So, I mean, what's your take on that point?
Yeah, tactically, I have been and remain bullish. You know my feeling about some of these pullbacks that we've had over the course of the year. I call them potholes, a pothole market, and you need to ride through them as investors because they're very fast and it's very difficult to trade in and out of them. This most recent pothole or pullback we had finally got to a 5% pullback on the S&P. Was maybe a little bit deeper and maybe a little bit more worrisome. There were some days that the selling was very heavy, as I've referenced in prior musings. Last week, I made that point. I think it was the 24th time we've had as aggressive selling as we had in such a short period of time. 24th time in the last 90 plus years. So not a very normal situation. So if you felt badly over the last couple of weeks, if you're a long investor, I'm long only. If you're a long only investor, you would have felt bad a couple of days over the last few weeks. Well, that's why. It was one of the worst periods in the last 90 years. Very aggressive selling in a very short period of time. But guess what? That sets up the opportunity, right? So my feeling is I continue to think that there's a pretty good chance of what I've been calling a performance chase into year end, because most of the fast money, smart money, hedge fund type investors are considerably underperforming the very basic S&P year to date. And so I do think that the good news is that, as you pointed out, we had the Delta fear, the China regulatory fear, the Evergrande fear, the supply chain concern, the energy shortfall issue. We've had every reason under the sun to sell. And now I think the good news is that has made what had been headwinds, namely sentiment. Sentiment had been quite bullish. Now that's no longer the case. Positioning had been quite long, definitely no longer the case. And seasonality had been, the August-September period known to be one of the worst periods. Now we're coming out of that, going into one of the best periods. So I think there are a lot of things lining up to suggest that we could have a performance chase into year end. And I noted that Goldman Sachs late last week came out calling for exactly that. And they added the point, which I hadn't thought of, which is that November and December are the number 1 and number 2 months for stock buybacks in the United States. And so they expect to see considerable amounts of stock buybacks in the next couple of months. And they also note that the systematic traders, the CTA community, had been huge sellers in September, have now flipped back to buying. So that's another kind of part of the investment community that has flipped the script from selling to buying. So yeah, I continue to think that that anyone who wanted to sell has sold. I would note that one of the guys I like to look to for the technical stuff at All Star Charts, J.C. Parrots, noted that 91% of the S&P 500 constituents have already had a 10% correction, and something like 98% of the NASDAQ constituents have already had a 10% correction. So we have had a stealth correction already for the bulk of the market. And so to me, I think we're well set up. Earnings, I think, are going to be fine. We already discussed it. The bar is low. Yeah. It's 7% below where Q2 was. And we're looking at a world where we have the reopening in Asia, which we talked about a month or so ago. That was something that we highlighted. That leads to the synchronized global expansion, which is the strategic outlook that we have here at TPW Advisory.
No, and adding, talking about Asia, I guess, people, GDP's numbers today, which decelerated from 7.9 to 4.9% in the third quarter. I guess they're in the price now. And what maybe not in the price is additional stimulus in China, as we discussed last time that there are two main events. One is the Olympics, Winter Olympics, and the other one is the election. The Politburo appointing or not Xi Jinping for a third mandate. So, what's your view on that? It seems that it's in the price, right? Looking at what happened to Chinese stocks today.
Yeah, I've been saying for some time that anybody who's wanted to sell China for any reason has already done so. We talked about Evergrande. That was in August. The regulatory edict with the antitrust with technology and social equality and tutoring, etc. That was August. Evergrande was September. And then over the last week or two, we've had all the coal issues and energy issues in China. So there's been every single possible reason to sell China if you'd wanted to sell it. And so guess what? When today's GDP number comes out, and it's definitely worse than expected, not dramatically worse, but worse than expected, Chinese stocks rose. Okay, the ETFs in the US were up today. And over the last month, China's done as well or better than the US and Europe. It's already in the price. There's only so many times you can sell a security, namely, one at a time. So to me, I think it's emblematic of the tactical outlook of a chase into year end. And strategically, yes, I think, China has been very disciplined about using either monetary or fiscal policy to bar the deceleration. And therefore, they have lots of bullets. The 10-year government bond in China yields over 3%. So there's plenty of room for the PBOC to act. But, so far they haven't, and maybe they won't. But I do think when you think about liquidity around the world, the Fed is going to taper. That's a given. Again, I think that's fully in the price. The ECB is going to take a very long time to move in that direction. And the PBOC is ready to eat should it be necessary, should they decide it's necessary. And those are the three main central banks. Bank of Japan, not really going to do much, hasn't done much for quite some time. And the Bank of England, talking more hawkish, but I don't really think the Bank of England, particularly now as it's pretty much just driving its own economy. It's not really a pace setter relative to the rest of the world. So when I think about the strategic outlook, looking out 2022, 2023, 2024, I think that we're in transition on several fronts, right, from a market perspective. The first is the transition from liquidity to earnings-driven markets. And we're early in that. And I would note that JP Morgan just came out with a report over the last couple of days saying they think there's excess liquidity in the system that's going to support above trend growth through at least 2022 and perhaps beyond. So that's one transition. The second transition is from growth led stock markets to cyclical and value led stock markets. That I think is underway. If you look at, you can punch up XLE, which is the energy ETF, versus XLK, which is the tech ETF, and you can see that action's already well underway. And I think we're going to get the real deal this time, not just the appetizer portion we got served in the spring when we had a couple months of cyclical value outperformance, and then it rolled over. If you look at the charts, and Roberto, I'm not a technician, but I do look at a fair amount of charts. If you look at the charts, particularly of the ETFs that we hold in our models to represent the cyclical value component, they've all gone sideways for like 6 months. They haven't done anything. So the idea that these are overbought, that the market's at its high, all that stuff is I think almost irrelevant. Because if the stuff that's going to move now, we talk about a twin engine market, right? When rates go up, cyclical and value does well. When rates go down, growth does well, and that's allowed the broad S&P to do pretty well this year in those two segments trade places. Now I think we're trading places for good, for some time, from growth and tech to cyclical and value, because of that third transition, which is from a bull market in bonds, which has been going on for 40 years, to a bear market in bonds. And when you look at the long-term trend line, the picture suggests that the 10-year U.S. Treasury has to get above 2% to really break that long-term downtrend line. And I think we're going to do that. I think the 10-year will be above 2% at some point in the next 6 to 9 months. So call it June of 2022. And I note that I just saw Invesco reported similar outlook. They're calling for a 10-year bond at 2.2% by the end of next year. So I think that's the third, and that's obviously a very major transition. That when you talk strategically, those are the three transitions from a market perspective. And then the overarching one, of course, is the climate shift from the climate change focus that we need to transition to.
Yeah, no, this is great, and I guess you answered already the question about the tapering. That it is already mostly in the price, and most likely the dollar is going to stop appreciating once the taper is announced. So
well, on that, sorry if I could just interject on that point, Roberto, because it is interesting. One of the things that I talk about in the musings was how the commodity asset class is the strongest looking one, technically stronger than equities, obviously stronger than fixed income. And I note that it's rare the dollar go up and commodities go up at the same time. And one of the ways that you can note that commodities are really in a strong bull market is that 100% of the Goldman Sachs Commodity Index constituents are up on a 3-year rolling basis. That's the first time in 17 years that 100% of that index is up on a rolling basis. So you have a very strong commodity bull market, even with dollar appreciation. And typically, as I say, that doesn't last very long. What happens is that the dollar rolls over, and then commodities get that next leg. So if you think about, what commodities have done so far with a stronger dollar, imagine what might happen should the dollar weaken to commodities. And I do think, as you pointed out, and I wrote my musings, I do think that the Fed taper is most likely going to be the top for the dollar, because I think that that's the news will then be clearly in the price. I think that next year we're going to see Europe and Japan grow faster than the United States. This is a key point that people haven't really gotten their heads wrapped around yet. Japan is the only major economy with this composite PMI under 50. Japan has a real opportunity to grow next year faster than the United States. Europe is going to grow most likely faster than the United States in 2022. So that will be the mindset that people have to focus on, as opposed to the exceptional nature of the U.S. fiscal response, the on and off exceptional nature of the U.S. response to COVID. But taper, I think, is more likely than not to mean that the dollar peak, and then it starts to roll over, gives commodities and non-U.S. equities and cyclicals and value, the next leg up, because you need to see continued catalysts for further appreciation on some of those transitions that we talked about. And I do think that commodities are definitely one, and a weaker dollar is the next leg, could provide the next leg up for the broad commodity space.
Mm-hmm. No, that makes total sense. And talking about commodities and energy transition, to some extent, we're talking before we went live about the setbacks in the U.S. In Biden's plan with politics and senator from Virginia trying to protect the coal jobs. So let's see how that goes. But what's your take?
Well, I think the news over the weekend that you're referring to, Senator Manchin of West Virginia, saying that he's not supportive of the clean electricity program, which was the centerpiece for the climate change part of the human infrastructure bill, seems to be the case. Is, I think, very disappointing. Certainly it was, as I said, the centerpiece really for the climate part of that infrastructure plan. And remember, the physical infrastructure bill that has already been approved by the Senate did not have a lot of climate specific work in it. That work was going to come in the human infrastructure bill. Okay. And now Senator Manchin, who you point out from a coal-producing state, though the work is very clear, coal provides a very, very, very small percentage of the GDP of West Virginia, very small percentage of the wages, very small percentage of the gains, the jobs in West Virginia. The idea that it's a massive coal-producing state is, 30 years old. But nonetheless, the senator seemingly objects to the clean electricity program, and that's very disappointing. And I think reflects the dysfunction that exists in the United States, where the Democrats have no votes at all, cannot lose a single Democratic senator. And let's keep in mind that, Senator Manchin may get a lot of criticism from the Democrats, but let's also remember there's not a single Republican senator who is going to support the human capital infrastructure bill that President Biden is seeking to have passed. And so it really, you have one party which is completely not participating, and you have the other party that cannot lose a single vote. The room to get things done is obviously very, very limited. And so, sadly, to me, I think it reflects very poorly on the U.S. In its standing in the world. I've argued in written work, and I think on this live sessions, that this was important to allow President Biden to go to Glasgow at the beginning of November for the COP26 climate summit, and show that the U.S. was able to lead. And now it seems as if he's not going to be able to do that. he's going to go to COP26 as a president who can't get his own party to agree on the centerpiece to deal with climate. And I do think it means that unless there's some sort of workaround that gets figured out, and I'm sure there are efforts being made on that front as we speak in Washington, but it really means that the likelihood of the U.S. to meet the Paris Accord targets for 2030 becomes very suspect. Because this, as I say, this was going to deal with the power generation part, right? There are two big emitting segments. There's the power generation and transportation. Transportation is all about stimulating the production and sale of electric vehicles and charging stations, et cetera, the infrastructure. And clean electricity program was meant to do the same on the power generation side. Yeah. So you're basically taking one part of it, the bigger part, and saying it's not, we're not going to do it, or we're going to do some less good workaround outcome. And so, as I said, I'm sure that workaround is being attempted in Washington. It is frustrating and very, as I said, I mean, I think it's a sign of the dysfunction of U.S. politics. Roberto, with my view of the tripolar world, and the U.S. and the Americas really competing increasingly with Europe and with Asia, the U.S. can't afford to have dysfunction and not really able to move forward on things as clear-cut as the need to deal with climate change. I mean, after the summer that we had with wildfires and floods and hurricanes, it's really hard to understand how we can't get folks around the idea that we need to move forward on the climate, that there's ways to do it, that there are ways to do it and an ability to save money, not spend huge amounts of money. I mean, there's so much work that's been done that makes it apparent that we can move forward. And yet, DC is sometimes not really all that focused on moving the country forward. It's much more focused on, kind of internal issues. And that would seem to be the case here. So very disappointing. It is interesting to kind of watch what happens to the clean energy and the climate focused ETFs in our models. Today I paid close attention to that. KRBN, which is the carbon ETF, was down about 1.5%. I'm not sure if that really had anything to do with the Manchin news over the weekend, but that's something we're going to pay attention to as we go forward.
Yeah, no, and as you said, I mean, it's a divisive, and dysfunctional political environment. So, I mean, of course, as you said, there's a lot of conversations going on right now, and people making a huge effort to fix that. So, I mean, we just, I mean, and in these cases, most of the time, it gets diluted, and he gets some kind of, of course, he knows he has leverage, and he's going to get some compensation for it.
Yes, I'm sure that's there's going to be lots of that being done, and the sausage making is never pretty. I had an aunt who worked in a meat packing plant, and she told me, if you knew, and this is decades and decades ago when I was a kid, but if you knew what was actually in the sausage, you'd never eat it. And so the sausage making of legislation is never pretty. And here in particular, when there's one or two people who can thumbs up or thumbs down the whole thing, obviously it gets kind of perverted and not really a great way to do business, as they say. So yeah, we're investors. Politics is part of the macro orbit, and so we pay attention to it. But it's not the only thing we're doing, and we continue to focus on the whole story, and particularly as we get into year end, the playbook for year end is really what we're focused on at this point.
Yeah, let's shift to that. Yeah, it sounds like a good idea.
Yeah, well, the playbook for year end is based off of the idea that we will have a chase into year end, that all the headwinds of the last couple months have turned into tailwinds, that we have had a stealth correction, that we are having the Asian reopening. We are going to have a synchronized global expansion spanning 2022, 2023, and perhaps beyond. And so we want to position our portfolios, and we have positioned our model portfolios, both our TPW20 thematic model as well as our global multi-asset model, for that type of environment. So we are, overweight equities. We are significantly underweight fixed income, and we are overweight commodities, which, as I mentioned earlier in the session, I think is the strongest looking of the three main asset classes. And within the equity position, we are overweight non-US equities, as we have been. The focus on Europe and Japan, particularly Japan. I would just point out that in September, there were a bunch of things that were kind of tossed out, baby with the bathwater style, as people reorganized their portfolios for the end of the month, end of quarter. And one of them was Japan. And I forget the firm that made this point, but one of the big Wall Street firms highlighted that the amount of foreign selling of Japanese equity in September was something like $7 billion, the biggest single month sale of Japanese equity since 2012. So we're really focused on Japan. We think it's a cyclical market, under-owned market, cheap market with a new government, a stimulus package likely coming. And as I pointed out earlier, it's got tremendous growth upside to catch up to what's been kind of 2 years almost for Japan of lost economic activity because of the severity of their lockdowns. 2021 has been pretty much a write-off. 2022, I think Japan will grow in a way that hasn't been seen in a number of years, and perhaps even grow more than the United States. So overweight non-US equity. Also focusing on some of the emerging markets. I mentioned Russia earlier on the energy play into Europe. Also Asia. We haven't sold a single ETF of our Asian equity exposure throughout the last couple months of all this China bashing. And then within the reopening trade, we continue to really like jets. The airline, we do think, the U.S. is opening its borders to vaccinated folks starting in less than a month, 3 weeks or so from now. So I do think that we like the jets opportunity on the reopening. And we continue to think that energy has broken out. So within the U.S. equity in particular, we're very heavily overweight cyclical and value, namely XLF and XLE, also AMP. Really like the energy space, and I think it's important to not sell energy too early. That I think would be a mistake. If you look at any of the longer term charts, if you look over the last 3 months or 6 months, energy looks like it's massively outperformed and we should sell it. But since COVID began, XLE is underperforming the S&P by about 25%. And over the last several years, it's underperforming by about 75%. So that suggests not to sell too early. And then on the financials, we like XLF. You mentioned the U.S. banks, but really the opportunity, I think, continues to be in Europe. The European banks sell at 9 times forward earnings. They traded at a 40% discount to the broader European stock market. And so there's really where I think the opportunity is, even more so than in XLF in the United States. And then last, but certainly not least, is the contrarian play, right? I actually did these notes for a Bloomberg hit on Thursday morning, which, because of some technical difficulties on my end, ended up being just a phone chat for 5 minutes or so. But the notes on the musings last week really were from that Bloomberg appearance. And I noted that a contrarian play, which is the China equity opportunity. And so we touched on it a couple of times here in this live session. But to me, it's been every reason to sell. They've been given multiple opportunities to sell. China now is super cheap relative to its history, relative to the U.S. Tech stocks in China have been, haven't been this cheap in years and years. So I think China equity, if you're looking, and that's often what happens when markets start to move up, people look at the things that haven't moved and buy them and catch the ride that way. And I think if you're thinking about doing something like that, you can't do much better than looking to get long China equity. I think very little downside and some pretty decent upside. So that's kind of the playbook for TPW Advisory as we head into year end. Pretty constructive, and thinking that the headwinds of the last several months have turned into tailwinds, and that's going to take us higher.
Mm-hmm. No, that's great. And there was also another question from the audience, going back to what you said way back, which is about lithium. So because I remember you mentioned quite a few times how much with the supply of lithium would have to go up in this decade to meet the auto production. So how are you playing that story? I mean, through ETFs or some producers? I mean, it's
yes, we are. We're definitely. I mean, we're 100% only ETF shop, so it is through ETFs, and the ETF we're using is LIT, LIT, and it's one of our biggest positions. We in our model portfolio update that we do every month was done a couple weeks ago. It's usually around the turn of the month. We consolidated some positions, and one of the positions we consolidated and increased fairly significantly was LIT. So it's now one of the biggest single positions we have in both the multi-asset and the TPW 20 thematic model. And it's behaving very, very well. Looks to be breaking out. It's been quite strong over the last couple of weeks. So that's worked out nicely for us and for our clients. And then we expect, again, to hold these things for some considerable period of time. And that doesn't mean that, maybe trade around them and take some profits at different times and add to them at different times. But, I think it's abundantly clear that the transportation side, particularly in the developed economies, is going to be one of the key areas that we'll see change dramatically as a result of needing to deal with climate change. So electric vehicles are going to be increasingly what you see on the roads, and they require batteries, and those batteries, for the most part, require lithium. So LIT kind of goes through the entire supply chain, as you'll see if you bring up the constituents, and that's a market that we think is going to need to have continued price increases to deal with the demand that is going to come down the pike over the next 5 to 10 years. And so these are, as I've said, I believe for the last year, and I believe, frankly, for the next several years, that there are going to be opportunities in both the fossil fuel side, because there is going to be a transition, as we've seen, and the clean energy side of the power world is going to be opportunities for investors to make money and to do well. And so I think that's certainly one of the things we're focused on. As I've mentioned before, climate has been and remains one of the single biggest segments of our different model portfolios. We think climate is the single biggest global macro trend of this decade. So as investors, you have to be aware of it. You have to understand it, and you really should be positioned in it in order to participate in what I think is going to be an absolute game-changing space over the next decade, without a doubt.
Yeah, no, fantastic, and I agree. I mean, with not just climate, but that this rally towards year end still has legs, and a question you get all the time. I mean, what can go wrong?
Yeah, well, there's always, and you need to have an answer.
Yeah.
You certainly should. I think what went wrong, you could have another Delta variant come out of nowhere and be vaccine resistant. That's the single biggest one that I think we have to start off with, given what we've seen in the last 2 years. There's no sign of that, which is wonderful. And so I think hopefully we can continue to vaccinate more and more people around the world so that the potential for variants to kind of grow in spaces where there hasn't been good
Yeah.
vaccination become less and less. I think that's one. Two, I guess, would be a major policy mistake from perhaps the Fed, skipping tapering and going right to tight or something like that. I think it's extremely unlikely, but that would be another. And then I think, again, you think about what drives stocks. I mean, we're most overweight equities and commodities. So what is our risk? Our risk is that something derails the bull markets in both. In the equity side, it's earnings. So I guess there could be the dramatic margin compression as a result of some of the supply demand imbalances and issues around labor, et cetera. That could be one. I don't think that plays out in the course of a couple of months. That's a couple of years. And I'm on the other side of that. I think there's going to be productivity and,
that's what I was going to say.
My view is that we have three big factors supporting the global economy, right? I guess the third one, and we can stop here, is if the strategic outlook of a synchronized global expansion doesn't materialize, then we should probably not be as overweight on equities or commodities as we are. Now, why do I think that we're going to have that synchronized global expansion? First of all, because all three regions are now reopening, right? Asia, Europe, and the Americas. And then secondly, we have three drivers, I believe, to strong global growth over the next couple of years. One is inventory restocking, right? All we're hearing about is, supply chain woes and stuff shortages. So we have a massive inventory rebuild and restock. We have very strong consumer demand, record household net worth in the US and in Europe, right? Stocks at all-time highs, housing prices never been higher, debt servicing never been lower as a percentage of household wealth. So very strong consumer demand and capacity. And then third, the CapEx boom that I think has been kind of kicked off by COVID, as companies have had to figure out how to produce without as many people or with fewer plants, et cetera. And then you have the climate change, like we just talked about with the electric vehicles and with lithium. The need to build out the global charging network is going to be significant. I think there's a CapEx boom that's quite likely to unfold. Companies have never had as much cash. Borrowing costs have never been lower. And if you're going to actually have wage hikes of a significant nature, then the impetus to replace labor with capital, manifests itself in a way that leads to more CapEx as well. And that, importantly, the thing that I'm watching for, all that I think is almost a given. What I'm watching for is the productivity surge that comes about from a CapEx boom, which allows and offsets the wage inflation pressure so that you get higher growth, both nominal and real. The nominal, higher GDP on a nominal basis is a given. It's a question of real. And so how much of that inflation gets taken away by the productivity increase? And we've had this in the 1990s. And I wrote a piece
that's what I was
not too
going to
long
say,
ago, back to the 1990s. Yeah, back to the 1990s. And the second half of the 90s, 95 to 99, was exactly this kind of an environment. You had a CapEx boom. You had productivity surge. You had 4.5% to 5% wages increase on average for 4 or 5 years. And yet inflation was only 2 to 3% because productivity growth was 2 to 3%. And it cut the inflationary part of the wage gain in half. And by the way, stocks averaged something like 15 to 20% a year. Yeah, some very, very good number. And frankly, I don't expect to see that in the United States. That could happen in the non-US markets. But the US, because of the big weight of the tech companies, I don't think that's going to happen in the US, because US will see higher interest rates. Those higher interest rates will act as a cap on the upside for the big cap growth tech stocks, and that will act as an anchor to the broad US equity market, which is why, on a strategic basis, I think the opportunity set is much more attractive outside the US than inside the US.
No, fantastic. So just over the mark, and we finished on a great note. So as we said, 2 or 3 sessions ago, party like it's 1999, almost, without.
I can't party like it's 1999 anymore, Roberto. Maybe you can.
Yeah, almost.
I can't party like that anymore.
No, but we can't say this because there was the internet correction after that. So
oh yes, God Almighty, that
without
was
the internet crash.
Yeah, well, that was brutal.
Yeah.
I was in the markets for that. Actually, I was head of asset allocation at Morgan Stanley in those days, and it was
those are the days.
Definitely rough. Yeah, for sure. But we can talk about that next time. So thanks for the opportunity to chat with you and your audience. And
thank
great
you.
as always.
It's great. So I'll see you next time.
Perfect. Thank you.
Thank you, Jay. Bye-bye. Take care.
Bye-bye.